Welcome to Rock Center Shorts. I'm Kristen Savell, Co-Executive Director at the Rock Center for Corporate Governance at Stanford. I have two guest speakers with me today. Teresa Hill is a partner at Orrick who serves clients in support of their sustainability, climate, impact investment, and renewable energy goals. Teresa specializes in buy-side renewable transactions for corporate purchasers and has helped clients secure global renewable portfolios across all major jurisdictions. John Eliason is also a partner at Orrick. In his more than 20 years advising tax equity investors and developers, John has played a pivotal role in the advancement of the renewables and alternative energy market. He continues to provide leadership in this sector by guiding clients on the implications of the Inflation Reduction Act. Welcome, Teresa and John.
Thank you.
There, Kristen. Thank you.
Today, we're going to talk about how companies can use the Inflation Reduction Act, or IRA, to support both their tax and their sustainability goals. But before we get into the details of how this works, we need to level set in terms of background. So John, can you remind us what the IRA is and give us a high-level overview of some of the key climate provisions within the Act? And I know the IRA is hundreds of pages long, so this is no small feat.
Yeah, Kristen, happy to do so. So in the middle of 2022, the Inflation Reduction Act was passed and has generally been viewed as a huge boost to renewable and alternative energy. The IRA created a bunch of additional new incentives for different types of emerging technologies in the form of additional tax credits available, federal tax credits, and then also created the ability for taxpayers who may not ordinarily be investors in renewable and alternative energy to purchase the tax credits that from those types of projects. That is a completely new development. We haven't had that before in the Internal Revenue Code. And the purpose of it was really to open up just new capital sources to invest in these projects to get them built, for us to hit our the U.S. to hit its goals with respect to clean energy. There's a lot of other things in the IRA, a lot of just exciting other incentives and other opportunities, but it's really those ones focused on renewable energy are the ones that that I spend my time working on, and we're really happy to kind of discuss those today with you.
So John, why is it such a big deal that these tax credits are now transferable?
So as much as we all love renewable energy, it's still in most markets, it's still not profitable for developers to build these projects. They still cost too much money, and when they're generating revenue from them, the power prices are not such that they are profitable without incentives. So, so tax incentives have been around for years, encouraging development of renewable and alternative energy assets. But often the developers themselves aren't in a position where they have sufficient tax liability to actually use the benefits that are available to them. So historically, we put together what are known as tax equity transactions, in which we bring in an outside investor into the ownership of that asset to get an allocation of those tax benefits. If that sounds kind of a lot of structure, mumbo jumbo, and kind of complex, it is. And the other thing that, in addition to the complexity, or maybe because of it, there's not a lot of tax equity investors out there willing to make these investments. So it constrains the ability to monetize the tax benefits and the incentives that are out there. So with the IRA coming out and allowing people just to buy tax credits, this is really intended to open up the market to allow just a ton of new investors to come into that space and participate without having to get into the complicated structuring. And just to really put numbers around it, the tax equity market you think about investors in the space historically, it has been between like 18 and $20 billion a year, which is a significant market. But it is represented by a small handful of global banks, probably represent about 3/4 of that, and then 1/4 everybody else. So it's kind of a small number of investors. The anticipated need for equity investment in the form of tax monetization, tax credit monetization, is probably closer to $100 billion a year, just for us to achieve the goals that we're trying to achieve here in the U.S. So the tax credit transfer space, allowing new participants, is looking to bridge that gap, and there's just incredible amount of interest. It's been remarkable how quickly the market has really responded to the new benefits.
So how does the marketplace for tax credit transfers operate?
So it's evolving, right? So we're basically still kind of in the early days. It wasn't until late last year before people started really transacting, even though the transfers were available even the beginning of 2023. The reason that there was a delay was that the industry was waiting for necessary guidance from the IRS and from the Department of Treasury as to how to actually effectuate the transactions. But it's designed as a purchase and sale. The parties come together, they enter into a purchase and sale agreement in which the buyer is agreeing to purchase the tax credits associated with the seller's project. And there's significant amount of representations and discussion about, like, how the risk allocation is developed in that space, but it is a single contract. And then it's important for the parties to very closely follow the rules that are out there to make sure it's an effective transfer. The buyer and seller file something with their tax return. It's called a transfer election statement, in which the buyer is basically saying, hey, I'm stepping into the shoes. I'm going to be viewed as a taxpayer with respect to these benefits. And they have to pay for the credits, obviously, right? So that's, but it's a pretty simple transaction, I guess, in the sense that it's a relatively straightforward one. Although, once again, we're still kind of in the earliest days here. The market hasn't developed or matured as much as I think it will over the next coming years.
Makes sense. And what type of companies should be thinking about participating in the tax credit transfer marketplace, both on the buyer side and the seller side?
So the sellers are going to be all like the major developers of renewable and alternative energy projects. They know who they are. These are the people who are building like wind farms and solar farms and standalone storage projects, but then also things like investing in fuel cells or clean hydrogen and things like this. The buyers are really just corporate taxpayers. If you have a tax liability, you can purchase credits at a discount and reduce your effective tax rate. And that's usually what corporations are looking to do, because taxes, that's a cost, right? And if we can reduce it, then we can be more competitive against, or other people in the market. There's a kind of an interesting segue, is that we're talking about credits that are coming from renewable and alternative energy. So one type of buyer who I'm quite interested in kind of seeing approach the market are the corporations who have sustainability goals as well, and then to find opportunities to pair the tax credit purchase with other components of that project to really benefit from to achieve sustainability goals.
Well, that actually dovetails nicely with my next question, because a number of companies have in recent years set sustainability goals to reduce their environmental footprint or accomplish other objectives to benefit society. So, Teresa, does the purchase of tax credit transfers alone help companies to further these sustainability goals?
Yeah, I think it's interesting. The tax credit transfer alone doesn't support those sustainability goals, right? So if you're just doing the tax credit transfer, even though it's coming from a renewable energy project, if you don't hold the renewable energy credits from that project, it really doesn't advance the sustainability goal. But this is where I think it gets interesting. I think you can achieve that, but it would require pairing it with another transaction or bundling those tax credit transfers with the renewable energy credits from that facility. But I think there is a little bit of a misconception in the market about what the tax credit transfer alone can do for sustainability goals. And alone, it's great at lowering your effective tax rate, but it doesn't achieve those sustainability goals. I think both John is getting these questions from, the Treasury and tax groups at our clients, but I'm getting the same questions from the sustainability groups. And this is really why John and I started talking about, what are the unique opportunities that we can use these tax credit transfers to really, do more and amplify what these companies are really trying to achieve on the sustainability side.
So let's dive into that a little bit more. What does this pairing actually look like in practice? Can you walk us through a few examples, Teresa?
Yeah, let me step back a little and sorry that this requires a little bit of history, but to really think about why it's compelling to pair these. I think you need to understand how most corporate buyers have been achieving these goals to date, right? So if you go back 10 years ago, the first corporate buyers who really set renewable energy targets were buying unbundled RECs. So at the time, if a utility went out and built a wind farm because they needed the electrons, they may not have cared about the renewable energy credits that were coming off of that, and they would sell them in the open market. And so some of the first corporate buyers who set renewable energy goals would buy those unbundled RECs, but they really felt like it wasn't making enough of an impact, right? They wanted to, instead of just buying sort of RECs that were out there from existing facilities, they wanted to more directly support decarbonization of the grid by ensuring that they were really supporting a new project in the grid. And, for a lot of reasons that are complicated and beyond this discussion, it's difficult. If you have a factory in X state, you may not be able to just go out and buy renewable energy and have it delivered to your factory, right? And so we ended up with a construct of these virtual power purchase agreements where corporations could go out and make these long-term commitments that really supported the revenue for these projects and helped bring new renewables onto the grid. And at the same time, they would get the renewable energy credits. And because these were fixed for floating swaps, there was the potential, if priced right, that they would actually fund the procurement of the renewable energy credits. So if the market was up compared to the fixed price, then these renewable energy credits would essentially be free, right? Or they would be receiving a check under these contracts. And so it was compelling from a funding perspective, because instead of going out and just writing a check every year for unbundled RECs, you were getting RECs from a specific facility and potentially making money, or at least not having to pay for your renewable energy credits. So that brings us to today, where these virtual power purchase agreements are still the predominant mechanism that corporations are using to buy renewable energy credits. But they're volatile. The forward price of energy is uncertain. You're not sure if that's actually going to mean your RECs are free, or that you're getting a check under these contracts. And so the reason I talk about all of that is then you think about these tax credit transfers and the fact that they are have a financial benefit for the companies. And then can you pair those, right, with some other transaction and use that as the funding mechanism, which would open up the opportunity to maybe move away from a virtual power purchase agreement if that's not what fits your company's needs, and do something else. And so I think your question was really like, what would that something else look like, right? So, I think the most compelling story would be if you could find a tax credit transfer and bundle that with the renewable energy credits from that same facility, right? And then you're telling a really holistic story about, not only using the renewable energy from that facility, but you know, the tax credit transfers are helping this new facility be built. Because as John said, you know, monetizing these tax credits is part of the revenue that these developers need to build a project. But I think there's other, you know, our understanding is that those are a little hard to find, right? Those bundled, you know, fully bundled projects may be difficult. But I think you could also construct a really good story about the tax credit transfer and then buying unbundled racks. And again, those had fallen out of favor, but I think there's reasons why coming back to that structure and using the savings for the tax credit from the tax credit transfer for those unbundled racks could be a really compelling, you know, structure for some clients. Where I think it gets really interesting is, you know, could you use those tax credit transfer, you know, the savings, the tax savings, to really think about something that's really company and brand focused, right? Like if you are an agricultural company that has a lot of impact in that way, you know, could your project, instead of doing a virtual power purchase agreement, be something more around reducing the carbon impact of the commodities that you're buying, if you're buying wheat or, you know, dairy products, or, you know, if you're a heavy water user, could you really be focused on something around, you know, water or waste or energy efficiency? You know, I think it opens up as a funding mechanism, doing some really interesting stuff. And if you have achieved your goals and you are really wanting to tell a story around, you know, maybe something more specific to like energy or environmental justice, or, you know, something impactful in the communities within which you operate. I think all of those are really interesting things that would move you away from the BPPA and achieve your sustainability goals, and really just use that tax credit transfer as a funding mechanism, you know, use a portion of the savings to really, you know, sell internally the use of those funds for something compelling on the sustainability side.
Right, so
Kristen,
it sounds
for
like, oh, go ahead, John.
Yeah, I was going to say, just to kind of give you an example. So we're working with a client right now who wants to buy $100 million of production tax credits, and that's an annual credit. It's a 10-year credit. So they're going to buy $10 million a year of credits for the next 10 years. I think that they're negotiating, we're still kind of in there, but I think that the pricing is going to come out to like 92 cents a dollar of credit. So that's an 8 million. That's an $8 million savings. And that's the money that that they can use then, right? To say, okay, well, so we, you know, rather than paying the federal government, right, we're going to basically provide that to achieve our sustainability goals. So it's really kind of an, you know, interesting new way of kind of looking at it, where and also where the corporations, right, they can kind of look at this stuff more holistically, right? It's a to the extent sometimes tax departments can be a little reluctant about like things that they think, okay, well, this sustainability goal, we don't quite understand this, you know, we're doing our taxes, but this allows the corporation to kind of, you know, to kind of think more holistically about this.
Right, and it sounds like you're getting the tax savings, you're getting the environmental benefit, and then there's also some reputational benefit as well, which is nice.
Absolutely.
Yeah, and I think that's where I mean, and again, my sort of last point was around the VPPA is a great structure and it gets you those renewable energy credits, but you know, there are so many opportunities for sustainability driven projects that might be closer to that company's, you know, core focus, right? When you look at, you know, water or energy transition or health of communities or, you know, all of these other things, I think you could end up with a really compelling, interesting company specific project that, you know, they would love to do, but don't have the funding for, And, maybe the tax team and the sustainability team go together and say, here's the funding, and here's this really interesting project that we wanted to do, but we didn't have the funding for. And I think the reputational impact of that could be great, because again, it's allowing you to really tailor these projects to something that's really meaningful for your core values as a company, rather than feeling like, oh, we have to go with a specific type of project like a BPPA, just because that's kind of how it's been done over the last, several years.
Right. And VPPA, voluntary power purchase agreement?
It's virtual power purchase agreement.
Virtual.
So yeah,
Okay.
but they are voluntary, right? And so this is, again, I think it's important to think about that, because these are right now voluntary purchases by these companies who've set internal goals. And so it does have to pencil for them, right? I mean, this isn't core to their business in the sense that it's not the product they're selling, but it may be core to the goals that they have set internally and publicly stated.
Right. So John, is this type of pairing new? I mean, is it available only because the IRA made tax credits transferable, or is this something that was possible even pre-IRA, when companies relied more heavily on traditional equity investments to reduce tax liability?
I mean, you could do a pairing with like a traditional tax equity investment, because that's also demonstrating like a savings through the allocation of credits, but it's greatly simplified now. I think that is important, because there's a lot of corporations out there that have sustainability goals that, once again, the tax equity investor space was so limited to now really opening it up. It's just creating a very tangible kind of set of just basically new savings that they have, that they can now just tap into without a whole lot of structuring and kind of understanding, and the headaches of being in the ownership of a project for several years, right? It's like they can purchase credits at a discount and kind of use that strategically as a new source of funds to use partially or fully to do the things that Teresa gets to do every day.
All right, last question. If an executive or board member is listening to this recording and they think, bundling tax goals with sustainability goals, this seems like a really good idea, but what are my next steps? How should my company evaluate the different options and determine the right approach? What is your advice to them? And Teresa, I'll start with you.
Well, I mean, I think a great thing to do is to connect those teams, right? Because often, like I said, John's talking to the tax group, I'm talking to the sustainability group. They may not be aware of this connective opportunity, right? And so, I'm sure the sustainability folks that I talk to would love for me to say, call your sustainability team and ask them what great project has been sitting on their desk that they've been dreaming about doing, and if they had funding for, they would go do it. And then, have them talk to the tax team and say, can we use this to get this funding, right? I mean, I think it's really about bringing those sides together and thinking about it holistically, as John was saying.
John, any practical takeaways?
Yeah, well, actually, I'm going to double down on what Teresa's saying. Really having those two parts of the company talking to each other, I think that is the real magic here. I've seen situations where the sustainability office wanted to do a tax equity transaction because they wanted to participate in the ownership of an asset and for their sustainability goals, and they brought the tax department in too late, and tax was like, okay, what are we doing here? So I feel like for an executive listening, if one of your core principles is to achieve sustainability for your company, make sure that that's a core principle that the entire company understands, right? Including the tax department, because often the tax department can be a little isolated, right? They're just focusing on how much tax they have to pay, both on a federal and state level. So having those groups work together, I think is the real secret to success here.
Well, wonderful. Thank you so much for joining me today, Teresa and John. And thanks to everyone in the audience for tuning in. I will see you next time.
Great, thank
Thank
you.
you.